Hi, good morning. You're watching Global Business Report with me, Karthik Malhotra. All the stories from the world of finance, business, economy around the world right here on Global Business Report. Stay tuned. Action-packed 5 stories coming your way in just the next 10 minutes or so. Now, stock markets reeled under pressure as the S&P 500 and Nasdaq experienced a significant and rather unexpected downturn. Alphabet, the tech giant that owns Google, has stumbled. It sent shockwaves through the markets. How's it impacting the broader tech sector, and what should investors do about it? And what are investors and experts really saying about the potential ripple effects? Let's take a look.
U.S. stocks finished lower across the board Wednesday. Blame it on Google parent Alphabet, which plunged nearly 10% after it posted disappointing earnings. Also, Treasury yields rose, reviving fears that interest rates could stay higher for longer. The Dow lost 1/3%, while the S&P 500 dropped more than 1%, and the Nasdaq more than 2%. Alphabet posted disappointing cloud services revenue, leading to its precipitous decline. Exential Wealth Advisors Chief Investment Officer Tim Courtney said the stock was priced for perfection, as are other technology giants.
The upside is these companies have provided great returns year to date. The downside is they have to keep on performing to justify these prices, which they are well out of their normal valuation range, these mega cap tech names.
Treasury yields moved back up near 5% after robust new home sales data and mortgage rates reaching 23-year highs affirmed market expectations of prolonged elevated interest rates heading into 2024. Other stocks on the move included Microsoft, which gained 3% following its better-than-expected quarterly results, and Facebook parent Meta Platforms, which reported revenue that topped estimates after the closing bell. Shares rose 4% in after-hours trading.
All right, let's stay with Microsoft and Google. Generative AI is literally disrupting big tech. Two industry giants find themselves on contrasting trajectories. While Microsoft is riding high, propelled by the surging power of artificial intelligence and its investments into OpenAI that owns ChatGPT, Google faces the challenge of keeping pace. The battle of AI is heating up, and its implications on the future of technology are here to stay. Let's take a look at this report.
AI is proving to be a mixed blessing for big tech. Nearly a year after the launch of ChatGPT, Microsoft is enjoying a boom. Analysts say it's benefited from aggressive investment in the technology, which includes backing the chatbot's maker, OpenAI. The tech titan has embedded artificial intelligence across its products, from its Office software to its search engine Bing. Numbers out Tuesday showed revenue soaring to more than $24 billion at its cloud unit over the latest quarter. That beat analyst forecasts, with one calling the numbers absolutely phenomenal. Microsoft also topped estimates for overall revenue, which rose to more than $56 billion. But it was a different story over at Google parent Alphabet. Cloud revenue there rose by around 1/5 to just over $8.4 billion. That was its slowest pace of growth in at least 11 quarters and lagged Wall Street estimates. The search giant did, however, beat estimates on profit and sales, but that didn't satisfy investors, who worry it's now lagging on AI and cloud services. Alphabet shares dropped as much as 7% in US after-hours trade, while Microsoft jumped as much as 5%.
All right, then let's move from the world of big tech and the world of AI into something else which has driven the US economy. US automaker General Motors is facing yet another challenge at its Escalade factory. The Escalade factory becomes the latest target in a wave of auto strikes. Workers have walked off the production line. What are they demanding? Well, they're demanding better wages and improved working conditions. The Escalade plant is the flagship model for General Motors, and any disruption in production could have far-reaching consequences. Let's take a look.
The US auto strike has ratcheted up another notch. On Tuesday, the Union of Auto Workers called a walkout at the General Motors assembly plant in Arlington, Texas. It makes some of the firm's most profitable vehicles, including Cadillac Escalade SUVs. GM said the stoppage meant the dispute would now cost it $400 million per week, double the previous figure. It's furloughed more workers as a result, with the total now standing at 2,460. The new walkout follows a similar move earlier in the week at a key pickup plant operated by Chrysler parent Stellantis. Workers have also gone on strike at Ford's biggest factory. Analysts say the moves target the industry's top-selling vehicles, raising the stakes for Detroit's big names. Now negotiations continue at all three firms, with none saying they've hit a total impasse. UAW President Shawn Fain says strong earnings figures reported this week by GM prove that the companies can afford big pay rises. Last week he said the trio had converged on a 23% wage hike offer, though GM and Ford said other cost of living measures took the total increase to over 30%. Fain has urged union members not to be swayed by that, saying there is more to be won. That leaves it unclear how far apart the union and automakers now really are. Consultants this week estimated that the strike's total cost to the industry had surpassed $9.3 billion.
All right, seems like no good news really emerging from US today. And it's not just the markets, it's not just big tech, it's not just auto majors, but a sobering financial development is sending shockwaves through the American housing market as well. Days of free money are practically over, at least for now. US mortgage rates have surged. They've surged to their highest point in more than 2 decades. That's right, a staggering 23-year peak that's leaving homeowners and prospective buyers sweating it out. Watch the story.
Janet Jackson was at the top of the U.S. pop charts. Bill Clinton was wrapping up his second term as U.S. president, and computer users all over the world had put the Y2K scare in the rearview mirror. It was September 2000, which was the last time the interest rate on the most popular U.S. home loan hit 7.9%, until last week. That's according to a survey out Wednesday from the Mortgage Bankers Association. It showed the average contract rate for a 30-year fixed-rate mortgage rose for the 7th straight week to its highest in more than 23 years. That has driven mortgage applications to a 28-year low. Economists say higher rates are keeping prospective home buyers out of the market. The cost of borrowing to buy a house has risen, even as the Federal Reserve has put its inflation-fighting rate hike campaign on pause. One bright spot in the housing market is new home sales. A separate report out Wednesday revealed they surged more than 12% last month, helped by a chronic shortage of previously owned homes, though they represent only a small percentage of total home sales.
All right, from a potential sort of property crisis brewing in the US as well as in China on the other end of the globe, let's move on from US across the Atlantic to the Eurozone, where there are new fears of an impending recession. New data reveals a disconcerting trend as the Eurozone appears to be sliding into recession. Here are all the numbers and expert insights into a not unlikely economic downturn. Take a look.
Eurozone business activity showed signs of flagging, and that could have the region sliding towards recession. Tuesday saw release of the October Purchasing Managers' Indexes for the bloc. The closely watched gauge of business health dropped to 46.5. That's the lowest in almost 3 years, or over a decade if you ignore the period of the global health crisis. It's also well below the 50-point mark that separates growth from contraction. The details of the October figures made even grimmer reading. A sub-index for the region's key service sector sank below all forecasts. One economist told Reuters that the numbers indicate hiring is all but frozen in the sector, while manufacturers are actually ramping up plans to shed jobs. Forward-looking indexes also sank, with numbers on new business and future output both declining. Put it all together, and some market watchers say it would be no surprise to see the Eurozone enter recession in the second half of the year. For now, though, that isn't quite the consensus view. A Reuters survey of economists predicts growth will flatline, but not fall, over the current quarter.
All right, impending recession there in the Eurozone, but slightly positive sort of good news to end the show with. In a significant milestone for the world of renewable energy, Shell-backed Husk is making waves as it secures a remarkable $100 million in funding for solar initiatives. Husk's substantial financial backing, it sort of marks a pivotal moment in the shift towards cleaner, more sustainable power sources. But what's Husk's game plan really for this $100 million investment? Let's take a look.
A US-based company has fundraised $103 million to build at least 1,400 mini solar grids in rural Africa and Asia, its chief executive has said. Manoj Sinha said Husk Power would invest two-thirds of the new funds in Africa, with plans to expand into Democratic Republic of Congo.
We would have a decent-sized footprint in DRC as well by utilizing this new funding. But our focus is going to be India and Nigeria, where we are going to increase our footprint from 200 to 1,500 mini grids.
The money was raised from existing equity holders Swedfund and Shell Ventures, Shell's venture capital arm. Shell is among oil majors who have long faced legal challenges over oil spills in Nigeria's Niger Delta, which they mostly blame on sabotage and vandalism of pipelines and illegal refining. Claimants have alleged that Shell oil spills have contaminated drinking water, destroyed farms, and harmed aquatic life. Husk said its funds had also been raised from new investors, including a French infrastructure investment vehicle and the US International Development Finance Corporation. Nigeria suffers from chronic power shortages due to a dilapidated transmission grid and generation constraints. Its 200 million population is often reliant on petrol and diesel generators. Sinha said the new funding, focused on Nigeria and India, would connect 300,000 households and small businesses to mini grids.
The growth rate in Nigeria is going to be astounding, much, much bigger than what we are planning to do in India.
Mini grids are made up of small-scale electricity units, typically ranging in size from a few kilowatts up to 10 megawatts, enough to power hundreds of households.
Well, here's wishing Manoj Sinha and Team Husk great luck with their investments on renewable solar energy, not just in India, but also in Nigeria. Well, that's a wrap on Global Business Report. We'll be back again tomorrow. So don't go anywhere. Stay on with News9 Live.
Literally every major power in the world is gearing up with its own digital currency. And so is India.